Happy Friday. Welcome to The Open right here on BNN Bloomberg. Let's get to those big stories we're bringing you from our newsroom. U.S. President Donald Trump says a deal with Iran may be nearing, and that's as a ceasefire between Israel and Hezbollah in Lebanon boosts hopes for broader peace. Trump said Iran has made new concessions, and he suggested a renewed truce or ceasefire may not be necessary, although officials say a full agreement could still take months. Oil prices have eased this morning on the news. Markets, though, of course, are still focused on the de facto closing of the Strait of Hormuz. Very few ships getting through. Canada-U.S. Trade Minister Dominic LeBlanc says the government wants to resolve trade frictions with the Trump administration as part of a comprehensive agreement, rather than through, quote, one-off deals. Speaking in the Commons, he was addressing the Standing Committee on International Trade. LeBlanc said the issues U.S. officials raised privately are the same ones they've outlined publicly. A report by the U.S. Trade Representative's Office flagged Canada's dairy system, amongst other concerns. West Fraser Timber says it expects to record a $73 million non-cash charge in Q1 due to preliminary softwood lumber duty rates. The anti-dumping and countervailing duties issued by the U.S. Department of Commerce are expected to be finalized and to come into effect this year. West Fraser also expects an additional $41 million non-cash charge anticipated from duty recovery estimate changes. And it looks like we're going to get new record highs for U.S. stocks when the market opens today. Both the Nasdaq and the S&P 500 closed at new highs yesterday. Let's have a look at the TSX, and it's virtually back into record territory, only a few hundred points short. Let's have a look at oil this morning, sliding down almost 10% on hopes of a settlement in the Middle East. President Trump indicating that Iran has made concessions. Let's have a look now at gold, see how it's faring. And of course, the reduced prospects of inflation from energy have raised hopes of interest rate cuts, and they're seen as good for gold. And finally, let's see how our currency is doing. And there you have it, up about 1/3 of a cent US. Okay, there may be optimism about a settlement in the Persian Gulf, U.S. stocks hitting record highs. But what about near-term economic data? Inflation is in for a spike, maybe short-term, because of this surge in energy prices. Investors are turning their attention to central bank rate decisions that are forthcoming. Let's get more from Earl Davis, head of fixed income and money markets at BMO Global Asset Management. Earl, thanks very much indeed for joining us.
Good morning. Always a pleasure to be here.
I know any kind of a military situation is impossible to forecast, including for the generals, but we are going to get at least a short-term jump in inflation from this oil price surge.
Yeah, we're for sure going to get that. We're already seeing it, the nominal jump in inflation just due to higher oil and gas prices in general. That's not a concern to us. Usually central bankers look through that. What we're, I wouldn't say concerned of, but what's definitely on our radar is where's inflation in 3 to 6 months, not driven by oil and gas, but driven by higher transportation costs. You know, we're seeing it in airlines and airline fees. You'll see that in packaging as well because of the petrochemicals, the fertilizer coming through food. So for us, inflation would be more of a concern in, let's call it a 6-month time frame. And I believe that's what people are waiting for. So right now, inflation nominally high, but we'll have to wait and see if there's flow through into the core inflation.
Yeah, it's interesting how this thing is just feeding through the entire industrial supply chain. Plastic prices going up, fertilizers, you name it. You still think, though, that the U.S. Fed will cut rates once or maybe twice this year?
Yes, and that's just the political pressure coming about, and especially they'll cut, especially if they do get the ceasefire, because at least people will say, you know what, inflation will not be sustainable, will be transitory. That's to be proven, but they will have a window in which they could cut if there's stability in regards to what's going on with the Iran war.
What about Canada? You're looking for muted growth, even though some commodities have done well?
Yes, muted like private sector growth. And that's, again, comes down to Kuzma. The uncertainty as to what the final new agreement will look like means businesses are still sitting on their hands. Having said that, we don't see a recession or anything coming out, because the thing that's going to replace private sector capex or capital expenditures is actually public sector capex through infrastructure, through military procurement. So there's a lot of public sector support for the economy, as well as one of the biggest global beneficiaries, if I could say that, of higher oil prices is Canada. There's a direct impact in our GDP, which is positive. So there's a lot of reasons to say Canada will not go into a recession. However, growth will be muted because of private sector spending and contribution to GDP.
I'm just looking at the headline here. Apparently, the Iranians, the Iranian foreign minister, is saying that the Strait of Hormuz is declared completely open for all commercial vehicles for the remaining period of the ceasefire. So that'll probably be seen as reassuring by investors today.
Oh, yes, for sure. And investors only have I've been in this industry for 30 years and an active manager. One of the things I could tell you is investors only have the ability to focus on one thing. So it's not going to be inflation right now. It's going to be the straight opening up commercially, at least politically. And the reason why I say that, there's a significant backlog. And also the commercial ships that will go through first are the oil and gas ships. Not the petrochemicals, not the fertilizers, not the sulfur, not the helium. And that's why we still see inflation as a concern in the backdrop, but that's not going to be a story until Q4.
Oh, we're looking now at oil over the past week, down around 14%. Maybe you can have a look at a one-year chart for oil, because, of course, it is still up from late February when the war started. What about Canadian housing? The numbers lackluster, the national benchmark housing price, which, of course, is a little misleading because markets are so different. But anyway, it has been in steady decline.
Yeah, steady decline. And it's not just housing sales in regards to secondary sales. It's primary. There's a backlog. New construction's not starting on new condos. There's a backlog of land. That is the reason why, even though the market's discounting a hike for the Bank of Canada this year, and I could come back to the reason why it is versus the U.S., even though they're discounting a hike, we believe there's a possibility of an ease driven by housing. And although the Bank of Canada's mandate is not housing, it's not growth, it's actually inflation. That's why the market is discounting a hike, because of the impact on inflation. That's their sole mandate. How they look at housing is in regards to future demand and its impact on inflation. So it could still have very much have an impact on what the central bank does. It's a secondary impact. We believe it's an important impact. And that's why we see the possibility of an ease this year, which is totally different from what the market is discounting of a hike.
I'm sorry, you're talking about the Bank of Canada there?
Bank of Canada, yes.
Right. Is the market anticipating a possible hike by the Bank of Canada?
Yes, they're anticipating one hike by the end of this year. And again, the reason why is the Bank of Canada has one sole mandate. It's inflation. Unlike the U.S., which has two mandates, which is inflation and full employment. So it gives them a lot more degrees of freedom, which is why they could possibly ease this year. But the Bank of Canada's mandate's inflation. So if inflation is their mandate, they should mechanically hike, to tell you the truth. But they're a qualitative bank, and they want to ensure consistent growth as well. So we do believe they will ease once by the end of the year.
That's interesting. Tiff Macklem, wow, that could be a hard one for him to justify with COSMA and the air, et cetera, and the American Central Bank cutting. But of course, the Bank of Canada has cut so much prior to this.
Yeah, and they cut a lot more than the U.S., which is why they've been on hold for a longer period in 2026. But again, the housing is a concern for us. We're seeing in numbers there's no immediate turnaround anticipated. There are mortgage renewals coming up, the last of the sort of the COVID low rate renewals, which will have an impact on demand. And we think that would be a consideration towards the latter part of this year.
Thank you very much, Earl. Really appreciate it. Earl Davis, Head of Fixed Income and Money Markets at BMO Global Asset Management. Coming up, the latest on the AI model that some say is too dangerous to deploy. And it's sending shockwaves through Wall Street. That's ahead. Let's have another look at oil intraday and maybe on a one-week basis. The Iranians now saying that passage for all commercial ships through the Strait of Hormuz is open. And that's encouraging investors to think that this energy crunch globally could be nearing an end. However, it's going to take weeks or months for the disruption to work its way through the system. And remember, we've heard about actual customers paying far more in the real physical market for oil than the futures would indicate. But certainly oil is down sharply right now. There is oil still up, though, 34% over the past year. It's held on to a lot of the gains that it posted after the war began, February 28th. Anthropic's new Mythos AI model has banks, tech giants, and governments scrambling to understand what could change for cybersecurity and the future of the internet. That model has found hundreds of vulnerabilities, apparently, in widely used software. Let's check out this Bloomberg doc, which explains why this Mythos model is raising alarms.
We have been hearing about this theoretical threat that AI poses to cybersecurity. And what Mythos has proven is that that threat is a reality.
And there's a huge concern that these systemically important institutions are at the highest risk of being attacked. Some of the top banking CEOs were invited by the top banking regulators, including Secretary of the Treasury Scott Bessent, to an urgent meeting in DC about Anthropic and its Mythos AI model.
Mythos is Anthropic's latest AI model that it had planned for general release, but has decided to take back and limit after discovering that it could be used for quite nefarious purposes.
It has the ability to detect vulnerabilities in basically every web browser, every computer system that it's so far been tested on.
Largely, it was autonomously able to go and find bugs and exploits and come up with a plan on how to take action on them and potentially do some harm.
You're talking potential holes in infrastructure that these banks might have been sitting on for years or decades and maybe haven't patched up.
That could be finding issues in financial payment services, web browsers, operating systems like on iPhones and Android.
If it's not used correctly, could essentially lead to some of the greatest cyber risks that humanity's ever faced. The Treasury Secretary Scott Bessent called this meeting, and he attended it with Jay Powell, who's the chair of the Federal Reserve. And the fact that the two of them were prepared to sit in a room together and talk to the leading bank CEOs about the same issue shows that this is more than just about politics.
Anthropic came to the decision not to release this very valuable tool for them. Rather than letting this out into the world and potentially people using this for malicious intent, they said, we're going to limit the amount of people who can use it.
The risks don't really stop in the US because we've also had the central banks of Canada, the UK as well, not just urging them about the risks that are exposed, but urging them to use the tool as much as possible. So one thing that's really unusual about Mythos is that Anthropic has created this Project Glasswing, which essentially gives its technology in a limited form to some of its competitors.
We know that Apple, Google, Palo Alto Networks, CrowdStrike, the Linux Foundation, Amazon are among the 48 or so folks that are part of this Glasswing project. These are fierce competitors, and Anthropic is not only showing them sort of some IP that hasn't been released yet, they're allowing their competitors to kind of feed back and potentially criticize some of the work that they did.
We've opened this out to a number of organizations, including Microsoft, AWS, some financial institutions, a very small cohort. And essentially, Mythos has really showed us that there are a lot of very severe vulnerabilities right now.
Banks already spend vast amounts on their technology, and that's one of the reasons that companies like Anthropic and OpenAI want to partner with them already.
And over the past couple of years, the major US banks have upped their spending on tech, partially in an effort to stay ahead of these future cyber threats.
Anthropic was really keen to point out that it's not an Anthropic problem. With the speed of the advances in the AI world, similar models with similar capabilities will be available within the next 12 months. It's hard to say, but it's highly likely that people with malicious intent would be very interested in creating a similar model. It's been a huge wake-up call, and that's why you're seeing things like Washington and Wall Street quite rightly concerned about this.
Okay, I guess one question might be for banks and stuff. If you can't keep the network safe, maybe just stop offering those services. Anyway, nobody asked my opinion, but I think this is going to be an excuse now when companies allow data leaks. Anyway, coming up, new data indicates that car buyers are increasingly choosing to go electric. Is this a profound shift for the auto markets? That's ahead. Canada may be seeing a shift in consumer behavior when it comes to electric vehicles. Overall new car sales declined in February, but EV sales moved sharply higher. CTV senior correspondent Annie Bergeron-Oliver breaks down the latest data and examines factors fueling this surge.
Electric vehicles don't sit on the lot long at this Ottawa car dealership.
We're actively always trying to get more vehicles in our inventory for this.
Sales are growing and customer interest is too.
Sales have increased for sure through the whole customer market looking into EVs.
Across Canada, more people are making the move from gas to electric. New data show that in February, electric vehicle sales increased 47.2% over the year before, while the sale of new passenger cars dropped.
In addition to the government incentives which are coming, obviously the war in the Middle East and kind of the impact on oil, but also the prices have gone down by a few thousand, so kind of, a few percentage points, and that had some of an impact.
Experts say Canada can meet the current demand, but in the years to come, far more investment in the energy grid and charging infrastructure are needed.
If a gas pump failed 1 in 20 times, there would be an outrage. And to support this wave of new EV drivers, we need to hit telecom-grade reliability, and that requires upskilling our trades, our electricians.
Those upgrades will be even more important as Canada begins selling a limited number of Chinese electric vehicles. Experts believe that move alone is likely to push up EV demand and bring prices down. But some fear the true cost of those changes.
If we take a wrong turn, an entire industrial ecosystem could be hollowed out or captured, leading to a dependency that erodes economic security, sovereignty, and democratic values.
Canada's Privacy Commissioner called on Parliament today to strengthen data laws and enforcement. Some experts have raised concerns about what kind of information these high-tech cars from China are collecting and potentially sharing.
CTV's Annie Bergeron-Oliver. Yesterday on Market Call, our guest was Ryan Bushell, Chief Executive and Portfolio Manager at New Haven Asset Management. He was covering Canadian dividend stocks, and his top ideas were premium brands, Canadian natural resources, and TELUS. And today on the show, it's David Driscoll, President and CEO of Liberty International Investment Management. He'll take your questions on global stocks. Here's a look at U.S. futures as we count down to the opening bells. And as you might expect, Stocks are poised in the States for an open at record levels. Of course, investors are probably going to be encouraged by this latest drop in oil prices after Iran said that the Strait of Hormuz is open to commercial traffic for the duration of the ceasefire. Netflix fell in the pre-market. The company gave a forecast for the second quarter that lagged expectations, stock down around 10%. And they also said that co-founder Reed Hastings, and he's now chairman, is stepping down after 29 years to pursue philanthropy and personal interests. So in the quarter we're now in, Netflix forecasts profit per share of 78 cents US, much less than the 84 cents projected by Wall Street. And of course, the dilemma here for the company is, will they have to ramp up spending radically to produce new content? And perhaps it's the departure of Reed Hastings is worrying investors as well. He's such a familiar figure. Now, they walked away from that battle for control of Warner Brothers, just conceding that deal to Paramount Skydance. Investors had been worried about the amount of debt Netflix would take on. Let's have a look now at the TSX Energy Index, or XEG, the energy producer ETF, because it's likely they could come under pressure today with this drop in oil. Thank you, control room. So you can see that ETF is off its highs, but still up more than 70% in the past year. If you want direct exposure, actually mostly to oil sands, that's an ETF you can buy. Let's have a quick look at Google and how it's been trading, because this Mythos product from Anthropic is shaking up the software industry. Apparently, ChatGPT has just said we're not releasing one of our products, one of our updates, because it's so dangerous. It really is amazing. We almost seem to be walking into a disaster here. These products are out there. They've been released to dozens of Silicon Valley and software companies. How long before they actually come on the market? And banks, of course, will have a great excuse now if they allow data to leak. But makes you wonder about the future of online commerce. Okay, we've got the opening bells next. There you have it, the opening bell action on Bay Street and Wall Street. At the NASDAQ, Kylera is ringing the opening bell. That company is working on GLP-1 remedies for obesity. It is time for the first 50. Trading is just getting underway. Let's check in on the North American benchmarks to see are U.S. stocks at yet another record. And sure enough, they are. Look at that, the S&P moving further above 7,000. And as you might expect, stocks are higher today with this drop in oil prices amid hopes for an actual end to the hostilities in the Persian Gulf, or at least an end to the actual violence. And so the S&P 500 in record territory. The TSX is nearing record territory. Interesting, it should be up on a day when oil is down so much. The TSX record high, I'm having a bit of trouble bringing that up, but we're not far off it. It was 34,541, and that was in early March. Few stocks of interest in Canada. Let's have a look at the usual suspects in energy to see how they're doing. And you can see, as you might expect, they are down with this drop of about 10% in oil prices today. Let's check out Suncor, and it is down about 4%. And Cenovus, CVE. So we've got three of the oil sands giants there. And let's have another look at this Xanadu quantum technology stock. So it's up again? What? Okay. 1 week, that stock is up fourfold. And Bloomberg notes that this has instantly, in a matter of days, made a billionaire of Christian Weidbrook. The company tripling, actually more than tripling in value. And as of yesterday, his stake, Christian Weidbrook's stake, was worth about $1.5 billion. Toronto-based Xanadu wants to build what's billed as one of the first quantum data centers by 2030. And, oh my goodness, NVIDIA released open source AI models that are designed to help the research. So Xanadu Quantum catching investors' attention. That'll be great, though, when we link up quantum technology and AI that can crack security barriers. We'll be off to the races then. Let's have a look at the stocks moving south of the border. And we're joined by Jeff Morgan. Markets up. Jeff Morgan will come up after the break. U.S. stocks trading at record territories. And we'll focus on this sell-off in Netflix this morning. We'll be right back. Now let's get to Jeff Morgan of Bloomberg. He's deputy team leader on the Bloomberg News Equities team. Happy Friday, Jeff. I don't know if Netflix watching is part of your weekend plans, but anyway, the stock under pressure.
The stock is under pressure. You're right. Not part of my weekend plans. Right now, it's the worst performing stock in the S&P 500, down 11%. It was the worst performing stock in the pre-market session as well. So quite a brutal quarter for them. Not only is the chairman and co-founder leaving, but also they really disappointed on the earnings per share front. They announced for the second quarter, they guided for the second quarter to 78 cents per share. Wall Street had expected 84 cents per share, and that prompted a handful of price targets, including at Barclays and at JP Morgan. Barclays noted that this company came into the quarter with some pretty high expectations. You know, they walked away from their deal to acquire the Warner Brothers Discovery business, and that initially sent the shares higher, that the company would be able to use some of that money that it didn't spend on its own business. And as I mentioned, expectations were high, and the guidance here didn't really meet that. So this is a company that also had recently increased their prices, which is maybe why Netflix is not on the menu for me this weekend. Recently increased their prices, and so there were high expectations for guidance that were not met here.
The aluminum prices have surged with the Gulf disruption, but Alcoa not delighting investors?
Yeah, that's right. Yeah, so you're right that aluminum prices have surged, and the problem is that also the Gulf disruptions have disrupted vessel traffic, and that is weighing on Alcoa's results. This had been one of the worst performing stocks in the S&P 500 in the pre-market session, up until we had the headline from about the Strait of Hormuz being reopened, and that sent a lot of the oil producers lower. So now the move that we're seeing here is still bad, but not. I guess more in line with the commodity producers more generally. Not only was there supply disruptions in the Strait of Hormuz, there was also disruptions with vessels in Australia, some weather-related impacts there. So adjusted earnings per share of $1.40, that was below Wall Street estimates of $1.70, and as a result, the stock is selling off this morning. Handful of other aluminum names selling off as well in other markets, kind of on the read-through here.
Jeff, thank you very much indeed.
Thank you.
Coming up, U.S. stocks hitting new records. Our guest says we're late in the cycle of a bull market. Stick with us. S&P 500 hitting a new record high today, putting the index on course for a third week of gains of more than 3%. It looks like optimism is back over AI, and there's speculation that the Americans are getting closer to a peace deal with Iran. Okay, no deal, though. No lasting settlement has been reached in the Middle East, of course. We're joined by Andrew Slimman, Managing Director and Senior Portfolio Manager at Morgan Stanley Investment Management. Andrew, thank you very much indeed for joining us as ever. What are you paying most attention to in the markets right now? What do you check first on your phone when you wake up?
Yeah, hi, Andy. So look, what I see going on is whenever there is a sniff, and today is more than just a sniff, of the war being behind us, the market is going back to the trades that were working before the war. Gold, weaker dollar, non-U.S. investments, AI beneficiaries, it's all the same trade. So I think the market is saying that the war may not be over, but the war is past for the stock market. So that's what I watch when I wake up, is what's working. It's telling me about kind of how the market is positioning.
And so, I mean, it's pretty stunning given this threat of inflation with not just oil going up, aluminum, chemicals, because of disruption from the war. But investors are I guess, discounting that, thinking that the price rises won't last too long.
Well, I mean, there is a kind of a history of when you get an oil shock, the early stages of the shock is the peak in oil. Oil backtracks, but it never, for the first 6-9 months, it doesn't get it back to where it was beforehand. So could it settle in? I see it's in the mid 80s. Could it settle in $80? I don't think that's going to derail the economy, especially here in the States, because what is less discussed is that there was the one big beautiful bill last year that passed a lot of consumer tax cuts that only started to hit in February and March. People are going to get, they're going to get checks back from the IRS coming in the next month or so, and that will help to offset the higher gas prices. I think that's less discussed. But there's no question, inflation is higher, and that's one of the reasons why I've always believed that President Trump was going to come to some agreement, whether it was a victory. He'll declare victory, whether it was a victory or not, that's another topic, because of the fact that how in the world could the Fed cut rates with oil sitting at $100 a barrel, and he wants rates lower going into the midterms in November. So he needed a truce out of the Middle East.
Let's put up charts, maybe stock charts for Goldman Sachs and Bank of America. Without commenting on individual stocks, Andrew, you think that banks generally are an area investors should consider right now?
Look, I think there's a lot of cheap stocks out there, Andy. And when I say cheap, my point is that when you think about it, yeah, the stock market is now breaking out a little bit, but it's really not made a lot of headway since, the third quarter of last year, but earnings have. And so the multiple on the market overall has come down from kind of 22, 23 to 18, 19. Now it's come back up a little bit, but a lot, and that's better earnings, but better earnings revisions. And the banks, especially, they've largely beaten on the upside. Now, the banks trade at a discount, and it's kind of muscle memory, Andy, which is people still remember 2008, 2009, and so they trade these big discounts. But I think we're in a very different situation today. Capital, they've had a ton of capital on reserve. That's being freed up. And I still say, why are the best banks in the world still trading at 35, 40% discounts to the S&P? I think over time, you have nirvana in this business, as you know, Andy, is earnings growth plus PE revaluation higher. I think you have a real opportunity where these banks trade closer, not to, but closer to a market multiple than they currently are, and you're getting good earnings growth. That is a very good scenario for investors.
Can we just loop back to a theme you touched on at the start? You're arguing that we're at the late stage in a bull market, and there's two plausible outcomes: a speculative surge in stocks, or bad news just grinds the market lower.
Correct. So what happened off the tariff low of April? the best performing stocks were the money losing technology stocks. And there's an index you can follow for that on Bloomberg. And that scares me, because when the money losing companies capture kind of the zeitgeist of investors, that's classic late euphoric stage. But what happened starting in the fourth quarter, we started to have these concerns about things, private credit, AI disruption, and then the war. And those money-losing stocks kind of lost their luster, and that's good news. You don't want that to happen, right? Mm-hmm. But since the war has receded, these stocks have come roaring back, and that scares me. So my argument is it's classic. We're following the cycle to a T, which is early in a bull market, there's way too much pessimism. Late in a bull market, you get a lot of optimism. That's what we saw at the start of this year. And then you get kind of either you get to the euphoric stage like we did in 2021, and then bad news really hurts, or you get, kind of shots along the way that pull back people's, optimism. And that's what we've seen. But it worries me. These stocks are now coming back and zooming. And, you saw that sneaker company the other day that rebranded itself as an AI company. Oh my gosh. That is classic euphoric.
Yeah, that's right. Allbirds, yes. We're AI now. Andrew, thanks.
Yeah, oh my gosh.
Andrew Sliman, Managing Director and Senior Portfolio Manager at Morgan Stanley Investment Management. When we come back, we're going to sit down with the CEO of Savaria, the big provider of mobility equipment, home lifts, stair lifts, obviously a demographic play as the population ages. We'll have that after the break. Savaria is a global maker of accessibility products. It just unveiled its 5-year strategy at an investor day. The target is $1.6 billion in revenue by 2030. Last year, the company had revenue a bit more than $900 million. We are joined by Sébastien Bourassa, President and CEO of Savaria. Thanks very much for giving us the time.
Good morning, Andrew.
So the thing you're best known for, and you were founded doing, were these home lifts for people who have trouble with stairs and stair lifts. So you're still big in that, but then you sell stuff for hospitals for lifting patients. And then your third big business is converting vehicles.
Yeah, so basically we are a leader in our accessibility division worldwide. We sell stair lift, home lift, incline platform. And we are very big in North America and in Europe, and we also do patient care, which is approximately 22% of our business, very specialized with bed, mattresses, and sitting lift. I would say the car business, we have exited that in the last 2 years, so that's not part of the portfolio anymore. But yes, we are lucky. We have an aging population, which is really playing in our favor, the demographic density of the population. So people want to stay at home. So yes, we have a good future.
One analyst I know is saying that people are staying at home partly because COVID raised fears about nursing homes and senior housing.
Yeah, and definitely we do. People want to stay at home. They want to age at home. But also we do a lot of effort to educate the population with the designer, architect, contractor, because unfortunately not enough people know about elevators. And you see that in the big city, townhouse, 3 to 4 floor. So even if you're 35, 40 years old, you want to bring your luggage up and down. You want to invite your parents. You want to create some plus value to resell your house eventually to all kind of population. So definitely there's a big work for us to do for educate the population to think about putting an elevator, to have this as a standard. If you go back 20 years ago, people were not putting AC or for air conditioner, but they have to have the same thinking to put elevator as standards as an AC.
That's interesting, isn't it? Maybe just build the elevator right into the house?
Yeah, for sure. Like when you work with them at the beginning, architect and designer, they will find a right place to put the elevator in the corner to have access, or they will put your glass elevator in the middle of the stairs to make it very spectacular. Or if you're doing some retrofit model, we have a new model, a through-the-floor elevator called the Luma. very easy to install and more affordable. So I think we have all kind of product.
Now, you took over, your dad ran the company for years, but you took over as CEO. When was it? Was it last year?
I think already time quite flies, but I think 3 years ago already.
Oh, okay, sorry.
And I was lucky. He gave me the pole, and he said, "Perfect. We're going to do a big project, which is called Savar One." So when I started, we started the Savar One project. Basically, we have invested $40 million into the business to professionalize the organization, work with outside consultant. And since the end of last year, the consultant are out of the building, and you can really see the performance of the company improve a lot in the last 2 years because we got better procurement, operation, sales excellence. And in the last 2 years, we have implemented over 400 initiatives, and we have been able to bring the margins from 15 to 20% of EBITDA. So it has been a very good teamwork that we have done internally.
What is the story with you and tariffs? Is that going to hurt you? Because obviously your products have a lot of metal in them.
Yeah, for sure. Again, we are lucky. I would say so as of today, because things are always changing in the last year. But all our finished goods, all our product, okay, there's no tariff on that. So basically, all the HS code that we use, they are tariff exempt. And after many of our products also for disabled people, Chapter 98. So again, they are really tariff free. The only small noise that we had in the last year or so is on spare parts. But again, we have all kind of project to be able to cover that. And one of the initiatives we did also last year is we were tired to discuss about tariffs. So we have opened, we have enlarged our Greenville factory in the U.S. to start to make accessibility products. So right now, we manufacture in the U.S. 40% of our home elevator are made in Greenville. The rest come from Canada because there's no tariff. But again, just by additional protection, we decided to invest just to be independent of that. Our business in Europe is not affected at all with tariff, and the business of patient care, we have 2 factories in the U.S., so we manufacture locally. So there's no big impact for us.
So revenue, you're telling investors you plan to get to 1.6 billion within a pretty few years. Give us the timetable on that. But your revenue was a bit more than 900 million last year.
Yeah, exactly. Yeah, we're in the business for the mid-long term. Okay, my father has been there for very, very many years. So basically, we want to grow the business at 12% per year, which would be a mix of organic growth. We want to aim for 7 to 8%. And the rest will be M&A acquisition of 4 to 5% per year. We have a good balance sheet. We have a net debt to EBITDA of slightly below 1, so we can make M&A. And for sure, if you look at 1.6 billion, and we have said that we'll have EBITDA margins of slightly over 20%, that will bring us to 320 million of EBITDA in 2030, and that will help us to bring the adjusted EBITDA per share. Our target is to go to 4.25. So I think it's quite some good target that will help to continue to be better and to challenge the team also to continue to do excellence. Right.
Thanks very much indeed. Really appreciate it. Sébastien Bourassa, President and CEO of Savaria. Okay, lots of market pros talk about picking high-quality stocks for the long term. Well, what's a recipe for finding those names? We are joined by BNN Bloomberg contributor John Ehrlichman, who has a new story on our website about building what you hope will be the perfect portfolio. John hosts Ticker Take on YouTube. John, this is based on Brian Belsky's playbook. Tell us what the main guidelines are, please.
Yeah, and viewers obviously know Belsky from his days at BMO. He has his own firm, Humulus, now, Andy. And when it comes to building a portfolio, it's something he's spent a lot of years doing for clients. Sometimes it's more U.S. focused, sometimes it's more Canada focused, sometimes it's a North American blend. The biggest lesson he has learned is that you have to identify the companies before you get all of the numbers, because he has seen when it comes to stock performance that stocks ultimately lead earnings and the economy. So once we're having the conversation around that latest economic data point or the latest set of earnings, there's already potentially a missed opportunity to build the return on that investment over the longer term if you weren't thinking about it before you saw those numbers, which is what leads him back to finding these really strong companies. I think the biggest theme in what he talked about with us, and there's a retail component, a consumer component, it's in a lot of cases companies that have very strong brand relationships and are showing steady growth.
Give us a couple of examples of stocks that might meet the criteria here, John.
Well, we talked about the high five stocks with Brian. 5 names that he really likes over the long term, and in many cases has owned for the long term. And people can get the full list on the BNN website. But I'll highlight 2 which have a consumer retail theme, as I was talking about. Let's start with a Canadian name, Aritzia, which, remember, wasn't that long ago, Andy. They had a couple of hiccups, and people were concerned about whether or not their expansion strategy was working. Well, here we are looking at the company's stock continuing to outperform. They've really had a strong expansion into the U.S. Brian argues that Canadian investors could afford to have more exposure to this company because of that. And then on the U.S. side, he's been a longtime fan of Costco. Obviously, a lot of investors are. He likes the stickiness of the business through the subscriptions and the fact that they've got all these spotlights, things that drive people to the stores. If gas prices are higher, Costco typically has the best gas prices. So that's a moat around their business. If you like Irish cheddar, Andy, you can get a great deal on a big block of that. So I think that the affordability factor works. And he also likes Costco because it's technically more in the staples category, and a lot of investors, when they're building a core portfolio, they have to have some exposure to staples, but it has some of the characteristics of a growth or discretionary stock as well.
Irish cheddar. Yeah, I have noted that Costco commercial outlet here in Scarborough has 2 kilo plus blocks of blue cheese. And John, I'm severely tempted. Anyway, better leave it there. John Ehrlichman. Okay, so you can find John's full story on our website, bnnbloomberg.ca, and on Ticker Take on YouTube and podcast platforms. Thanks again, John. Up next, will this market rally roll into the weekend? That's ahead. Welcome to the second hour of The Open. Let's check out the big stories we're bringing you from the BNN Bloomberg newsroom. The price of oil plummeting today, down 11%, after Iran said the Strait of Hormuz is now completely open. The foreign minister made the announcement in a post on X, aka Twitter, saying that in line with the ceasefire in Lebanon, the passage for all commercial vessels through the Strait of Hormuz is completely open for the remainder of the ceasefire period. U.S. President Donald Trump also posted about the reopening on Truth Social. He thanked Iran for the decision. Netflix shares dropping 10% after the company issued a weaker than expected profit outlook for the current quarter and said that co-founder Reed Hastings will step down from the board. Netflix forecasts second quarter profit below expectations and projected revenue that also missed estimates. The company says it plans to boost spending on content and expand sports programming. However, leadership is emphasizing capital discipline after the company walked away from its bid for Warner Brothers Discovery. And Alcoa shares down about 6% after the company's earnings and sales missed estimates. Operational disruptions such as maintenance, outages and supply issues linked to the closure of the Strait of Hormuz weighed on results. Alcoa says higher energy and freight costs have offset stronger demand. Aluminum hubs, including the United Arab Emirates and Bahrain, have been forced to cut production. And there is a look at the TSX holding its own today, despite this sharp drop in oil prices. Let's have a quick look at the U.S. markets, which have hit new, fresh record highs today. And you can see they are moving up with the Nasdaq gaining more than 1%. The Nasdaq now on track for a 5% weekly gain. Let's get perspective on this rally from Andrew Pyle, Senior Investment Advisor and Senior Portfolio Manager at CIBC Wood Gundy. Andrew, thanks very much. What should investors bear in mind about the current stock market? Is there euphoria, do you think?
Well, great to be here, Andy, as usual. There is definitely euphoria. I think coming into this morning, the mood was lifted, and we've seen this lift in the mood throughout this week. But there was still that suspicion, Andy, that, what's going to happen next going into the weekend. You've still got traders that perhaps didn't want to go into this weekend long. And of course, until we saw the Iran headline, and that really kind of opened the gates, so to speak, for this momentum to carry through. And again, I would argue that, we still don't have all the details yet, but it clearly has injected a huge amount of relief into this market, a very susceptible market.
One thing that's really been striking, I think, is the recovery in the big AI stocks. Maybe we could, or AI-related stocks. We could have a look at maybe a one-year chart for Meta or for Amazon. They're partly an AI play through AWS. Looks like investors are not worried about excessive spending on AI.
No, although we were thinking about this and talking about this before the Iran war, and there's a lot of risks in this market before, but keep in mind what has happened now. If this really truly is, Andy, the end of the war, if it's in sight, that takes a number of things off the table that would have dragged down the likes of the Mag 7, including the state of the U.S. economy, or the global economy for that matter. And also, where did we see interest rates going? Long-term rates were at risk of rising, which was not going to be a positive influence for this segment of the market. Take a look at what we have this morning. In addition to the equity market having a party, Andy, we have bond yields now moving lower because perhaps that inflation concern's out, and that really is going to be positive news for that segment of the market.
What do you think Canadian investors should do right now? Should they play it safe, maybe load up on banks, for example? I know you work for a bank.
Well, the messaging to clients has been for the last number of weeks is do not make drastic changes to the portfolio based on headlines. We need to see more fundamental evidence to make a decision either bearishly or bullishly, Andy. But I would apply that same logic to today. We have seen a massive move higher in this market, and it's going to be tempting for a lot of investors to look back to last April when we saw the markets, or at least in the US, lose 19%, get back to where they were, and then extend that rally another 13 to 14% coming into this January. That's a very tempting theme. I think I would push back on that because, again, this is a different situation currently.
And you think that we're back? FOMO, fear of missing out.
Well, FOMO is going to be alive and well today, Andy, as we know, because all you need to do is look back to last Tuesday when we thought someone wanted to take out a civilization. We had a lot of investors globally looking at whether they needed to really pull back on risk. Obviously, that need dissipated. And for a lot of investors, it's going to be, well, I could have been playing in this market today. Look at the gains that we're seeing. So I would say FOMO is going to come back. Now, the question is, Andy, how long can FOMO take the momentum of this market forward? And again, I would push back on the belief that this is now opening the gates for a multi-month rally in stocks, because there are other things for us to contend with.
Sorry, give us that again. It opens the gates to what, Andrew?
Well, I think a lot of people are going to think that this is a repeat of last year, where now there's smooth sailing ahead. There's no risks really facing this market. Keep in mind, Andy, a lot of things in the pipeline that have been created by this war are still in the pipeline. We are not going to rebuild energy infrastructure in the Middle East overnight, nor are we going to affect the prices of fertilizer, aluminum, helium overnight. Those things are in the pipeline, and they are going to have impacts on consumers. It's going to have an impact on businesses, perhaps not as much after today. But again, today is just today. Details, the devil's in the details, as they say, Andy. So I think we've got a weekend to ponder what is exactly happening in the Middle East.
One index that you think is showing signs of overbought territory is the Dow Transports. I don't think we can show those, but you note, oh, we can. I'm sorry. Yep, there we have it. It's been surging, and one catalyst lately has been a jump in Avis, the car rental crowd, because Apparently, people are tired of standing in lineups at airports, so they're renting cars to travel.
Well, exactly. And this market or this stock has just taken off. It almost looks like a meme stock if it wasn't so expensive, Andy. And you're absolutely right. This stock has been one of the benefits or the benefiting stocks from what has happened with the TSA, with the lineups at airports. Begs a question now, if we are going to take the risk off the table with respect to the war, if, for example, TSA conditions start to stabilize, what is the value in the stock? So I think, again, the stock looks extremely overvalued right now, and it has pushed this particular segment of the Dow, which, Andy, we used to look at a lot. Back in the day, Dow Transports was your confirming index, 20, 30 years ago for whether this rally could continue. A lot of people have been looking at this index said, there's no end in sight for this rally. Again, I would push back on that slightly.
Andrew, thank you very much.
Pleasure, Andy.
Andrew Pyle, Senior Investment Advisor and Senior Portfolio Manager at CIBC Wood Gundy. Coming up, why Canada is rethinking its telecom infrastructure amid tensions with the US, and what this could mean for the country's biggest telecom suppliers. Ever since Donald Trump returned to office south of the border and began making threats against traditional U.S. allies, officials in Ottawa have been figuring out what this country's vulnerabilities are. And here's one, the internet. We're joined by Bloomberg's Montreal Bureau Chief, Mathieu Dion. Mathieu, what is the challenge here?
Yeah, well, so what happened here, just to give you some background, we had a prominent American economist on a podcast, a Bloomberg podcast, not a long time ago. His name is Adam Posen. And during this podcast, he said that Canada entirely relies on the US to have access to internet. And that was quite surprising to me. So I started digging into this and asking questions. And it turns out like it's kind of true that Canada relies on the US. Here's why. So submarine cables connecting Canada with the rest of the world. There are only 4 right now that goes between Canada and Europe, 3, and 1 between the west coast of Canada and Asia, owned by Google. The other ones are owned by a company that is backed by a US private equity, and the last one is owned by Greenland. So Canada does not have any Canadian entity owning a submarine cable connecting the country with the rest of the world. All the data flows through the US, essentially. So if you're sending from Toronto an email to Tokyo or London, it's highly likely that it would go through the US. And if the response comes back, it will go through the US as well. If you're sending an email to me from Toronto to Montreal, it's likely that it will go through the US as well. This is a boomerang effect. So there's this infrastructure that has been put in place over years as the US was a reliable partner, right? And now with everything going on, you can ask yourself the question, could the US shut down Canada's internet if things were to go south with the current administration? So I made some calls and a government source confirmed that the Canadian government is actually conducting a review about the situation of its international communications infrastructure. And that includes submarine cables. So it may come as a surprise to you, but that's the current situation. And I asked BCE's Bell's CEO Mirko Bibic what he thought about that, about maybe having submarine cables that were owned by a Canadian entity. And he said that it would be wise to explore.
It's interesting. Right at the outbreak of World War I, the British Navy cut Germany's submarine cables. So it's interesting how history repeating in terms of these concerns. But if Canada was to have domestically owned submarine cables, what would the cost be?
Yeah, well, so you talk about having a cable that could be cut, and that could, like having one cable that could be easily cut That's actually like, is it worth having one, right? You can ask yourself the question. You would need more than one cable just for redundancy. One submarine cables can cost about, according to experts, between Canada and the lowest point to Europe could cost something like $300 million, Canadian dollars. But on-land infrastructure can cost much more than that. So it's not billions of dollars, but it's still very expensive. And that's the situation as of today. And all we know so far is that Canada is reviewing the situation. There's no plans, as far as we know, that they're planning to build such a submarine cables. But all this story makes you think about how much Canada's economy has relied on its close U.S. ties with the U.S., right?
Mathieu, thank you very much indeed. That's Bloomberg's Montreal Bureau Chief, Mathieu Dion. Coming up, power demand has been climbing for the first time since 2008, thanks to demand from data centers. We'll drill into what this means for energy companies after the break. Power demand has been increasing for the first time since 2008, and a big factor has been demand from data centers, partly to crunch artificial intelligence. Nuclear and renewable energy companies have been stepping forward, saying they can help fill the need for electricity. But our guest cautions that successful technologies don't always mean well-performing stocks. We're joined by Jonathan Pregel, Head of Power, Utilities and Alternatives at Calvert. Jonathan, thanks very much for joining us. It's interesting that reference to power consumption, that's in the United States?
Yes. So since the financial crisis, power demand did decouple, and in developed markets, it stopped growing altogether. And this was due to things like energy efficiency measures and the offshoring of energy-intensive industries like manufacturing to the emerging markets.
That's interesting, but now we've got this turnaround. There's near euphoria over some of these electric generation stocks. I mean, let's have a look at Vistra or Constellation Energy. You have a note of caution here. Tell us about that.
Yeah. So if you look at the solar industry, for example, I think it's a really good case study in the way that growth can but doesn't always lead to shareholder value creation. And so from a commercial technology perspective, solar has been, in a way, uniquely successful. It's the cheapest source of power demand in the world today, and we expect it to stay that way. And since 2010, the amount of solar that we've added to the grid globally is up about 45x, which is just astounding growth. But if you look at the overall industry and you look at the stocks, I think generously you could say that they don't reflect that level of growth. And the reason is pretty simple, which is that it's a highly competitive industry. And over the past 15 years, margins and return on capital have gradually fallen. And so we think that speaks to the importance of identifying companies that operate with advantaged economic frameworks, companies that exist in market niches where lower levels of competition allow them to retain some of the economics.
So you feel that solar stocks broadly have been neglected unjustly?
So our view is that it's a very competitive industry, and it has been challenging for the solar industry to convert a lot of that growth into shareholder value. And I would caveat that by saying that we have and continue to find areas within the solar complex where companies are delivering a lot of shareholder value. But by and large, it's a very, very challenging space, like a lot of the clean energy manufacturing verticals.
Coal, U.S. President Donald Trump obviously vocal in the support of coal, but we're not going to see a wave of new coal generation, you don't think?
No, we're not going to build coal. Really, the only place that coal is being built anywhere in the world is China. They make up something like 70% of all capacity additions, and nearly all of it is relegated to Southeast Asia. The rest of the world is retiring coal, including the U.S. And I would note that historically, renewables haven't been the enemy of coal. It's been natural gas and the abundant low cost reserves that are available in this country that's cut the coal fleet in half over the past 20 years. We think that it's simply too expensive, too inefficient, and inflexible. And today, what the grid needs more than anything else is flexibility.
What about nat gas? You reckon that the shortage of important equipment, such as turbines, is an important drag on that sector?
It is. So we are seeing material new gas builds, but the key constraint today, like you said, is around component shortages. Gas turbines are largely sold out through the 2020s, and this has led to some really significant cost inflation. And this is before we talk about rising commodity prices. The cost to actually build a gas plant itself has, in some cases, tripled since COVID. And if I were going to compare that to the cost for components in technologies like wind and solar, some of those component costs are down 30 to 50% since COVID. And so you have a really wide delta in terms of raw material costs.
And nuclear, lots of hype there. Maybe we can put up a 5-year chart for Cameco, CCO, a big Canadian uranium producer, especially these small modular reactors. But a lot of the industry's hopes are based on unproved technologies.
Yeah, so we're optimistic on nuclear. We're really excited about a number of the designs that are in the market today, these small modular reactors. But it's important to note that we don't see this as any earlier than a mid-2030s phenomena. And that's mainly because we think that it's going to take time to incorporate learnings from these first-of-their-kind reactors, drive down costs to make it cost competitive, build up supply chains. So in the meantime, what we can build are wind, solar, and batteries. And we think that that's going to represent the large majority of capacity additions over the coming decade.
I sometimes wonder about these nuclear cost overruns. Of course, some people are making money over those massive overruns. I wonder, is there a conflict there?
So the history of nuclear construction in this country doesn't have the best track record. It's been very expensive. It's prone to timelines getting pushed out. And this is something that small modular, in theory, should be able to address, is the repeatability. Part of why we've been able to build out gas so quickly is that the designs for gas plants are off the shelf versus complete custom jobs. And so this is something that the SMR companies are attempting to tackle. And I think time will tell what that looks like.
Just give us your thoughts on regular electrical generation companies. And actually, you have a company you'd like to highlight here, Excel. You're not recommending it, but you think it's an interesting case study. Just talk to us about that one, please.
Yeah, absolutely. So Excel is a company that we like. We think that this is a company that's really well levered to rising power demand. They own and operate electric grids and power plants across the country. And they have what we would view to be a leading sustainability profile. And this is something that's very core to how we look at the world at Calvert as a responsible investor. From an environmental perspective, they are on track to reduce emissions 80% by 2030, and they've already made a lot of progress. So they've closed 26 coal units so far since 2007, and they're replacing a lot of that capacity with natural gas and wind. And importantly, the company has had no employee layoffs associated with these coal closures. And we think that that is really remarkable. And we think that's the gold standard that companies in this industry should be aspiring to in terms of demonstrating that a fleet transition can be done in a way that doesn't disadvantage workers. And so in our view, this is a company that sits at the center of a very enviable Venn diagram of companies that are demonstrating leadership and sustainability and companies that are driving strong returns for shareholders.
Thank you very much, Jonathan. Really appreciate it. Jonathan Pragle, Head of Power, Utilities and Alternatives at Calvert. Just to update you on some statements from U.S. President Donald Trump, he is saying that the Iranians are now, apparently with U.S. help, removing mines from the Strait of Hormuz. He's also thanking Saudi Arabia. United Arab Emirates and Qatar for your great bravery and help. New York Times has an interesting story saying the Iranians say that, sure, the Strait of Hormuz is reopening, but ships apparently have to go along a coordinated route that runs close to the Iranian coast. So it looks like the Iranians saying they still have the power to dictate how ships pass through the Strait of Hormuz. I haven't seen anything about these tolls that the Iranians were talking about, that they would charge ships. Of course, the shipping industry dead against that. Coming up, shares in Netflix are in free fall this morning after the forecast missed expectations. Canada-U.S. Trade Minister Dominic LeBlanc says the government wants to resolve trade frictions with the Trump administration as part of a comprehensive agreement rather than through one-off deals. Speaking at the House of Commons Standing Committee on International Trade, the minister said the issues that U.S. officials raise privately are the same ones they've outlined publicly. A report from the U.S. Trade Representative's Office flagged Canada's dairy system, amongst other concerns. West Fraser Timber says it expects to record a $73 million non-cash charge in Q1 due to preliminary softwood lumber duty rates. The anti-dumping and countervailing duties issued by the U.S. Department of Commerce are expected to be finalized and come into effect later this year. And West Fraser also expects an additional $41 million non-cash charge anticipated from the change in estimates on recovery of duties. The Terranet National Bank House Price Index fell by 1% from February to March. It was the fourth consecutive monthly decline. Halifax recorded the largest drop. Prices there fell by more than 3.5%. Vancouver and Toronto were next. Prices in both cities fell by about 2%. The index indicates that prices are down 5% year over year. And there's a look at North American markets. U.S. stocks jumping to a new high, inspired partly by news that Iran says the Strait of Hormuz is open to commercial traffic. Let's have a quick look at oil because it has been sliding on the prospect of more hydrocarbon flows through that crucial waterway. Oil now down almost 12%, but still higher substantially from late February when the war began. And let's have a look at gold. You would think that diminishing inflation prospects would be bad for gold, but of course in the topsy-turvy world of finance, it makes interest rate cuts more likely, and that is seen as good for gold. And finally, let's have a look at the Canadian dollar, and it's holding its own today, up around 1/3 of a US cent. Shares in Netflix down sharply today. The company's forecast for the current quarter came in below expectations. We are joined by Matthew Dolgan, Senior Equity Analyst at Morningstar. Thanks very much indeed for joining us.
Hi, Andrew. Thanks for having me.
This is interesting. Just reading your analysis here. Your fair value estimate on Netflix is only $80. And one thing that gives you pause on this stock is you say that to grow, they need to keep hiking prices, but there's a limit to that.
Yeah, that's the crux of exactly what we're saying. To be specific, to grow at, let's say, at least a rate in the teens on the top line each year is what they will need the price increases for. And we think that the couple of things that the market has maybe come around to seeing a little bit today is that, first of all, that is what it's going to take, the price increases, which we got in March just this year in the U.S., the biggest market. And second, they need to come every year. And so although this time it was only 14 months since the last one, that's a really quick pace. And we don't think at these rates, especially more than a 10% increase to the prices for subscribers, we don't think that they can do that every year, despite it being the best service and subscribers wanting it. It's not something they can do every single year. And we think that's what it would take to get the type of growth that the market has been pricing in our view. And we think that's looking a little bit less likely.
That's interesting. I mean, for a lot of people, Netflix would be seen as essential, and it's cheaper than a night out of the movies with parking and popcorn and everything. But you think there is a limit?
I do, and there are a couple of other things that maybe get a little bit more nuanced. For one thing, with these streaming subscriptions, you don't need to be subscribed constantly. So even if you want to see something on Netflix, you don't have to be subscribed 12 months out of the year to get all the content you want, because you can watch it in chunks. That's actually one reason why they're making a little bit bigger push into the live events. But secondly, the really interesting thing about the ad-supported plan now is that it is a way, an alternative for consumers to maybe pay a little bit less to get the same content. The issue is right now in the US, for example, the difference in price is $11 per month. And that's not an amount that we think Netflix is getting anywhere close to making up in ad revenue per subscriber. So of course it can grow, and growing ad revenue is a huge part of what will lead to more revenue per user and revenue growing for this company. But first, you have to offset any of that mix shift from non-ad subscribers to ad subscribers. It's just another variable that makes it tougher to grow at the rate that we think the market got accustomed to in the mid-teens, when there was so much opportunity to add subscribers on top of sporadic price increases.
What about Asia? Apparently, the World Baseball Classic did well in Japan, but the growth in Asia was slow compared to previous periods.
Yeah, growth was still good, and it was still the highest growing market, but it was down from every quarter last year. And that was with this huge bump in Japan on the World Baseball Classic. And just from management's commentary, strong markets throughout Asia. Like I said, even with that, it's a little bit down after adjusting for currencies compared to last year. And the other international markets, same story, and actually even more visible, the amount that they've slowed, which is, again, not overly concerning. They're growing well. Netflix is a great company with growth in front of it, but there are reasons to think that it can't grow at the rate that we just think the market was pricing it. We simply think that a great company has been priced too expensively, and it is in a more mature phase now and should be priced appropriately.
I know critics, though, say Netflix still creates surprises. Original ideas for shows. It has Death by Lightning. It's a 4-episode Netflix drama depicting the rise and assassination of President James Garfield. He was shot in Washington, and I mean that's an off-base idea, and it's meant to be a great show, Death by Lightning.
Yeah, more broadly, Netflix, first of all, does put out great content that people want to see. And second of all, we think that people find it more on Netflix. So once again, but this is part of the Netflix story. It's kind of a given that they need to, and that they do, put out content that is viewed, that their engagement is really, is really high and blows away all the competition. But with all of that, you still need to find a way to, again, let's say mid-teens growth for where the stock was priced. And this is a necessity to get there, continuing to put out content like this, but not sufficient by itself. And like I said, we've struggled to find the ways that make it likely on a year-to-year basis they continue at that rate.
What about sports? Have they invested very heavily in sport events?
They haven't yet invested very heavily if you're talking about like how much of their content budget is going towards it. However, they have increasingly gotten much more into one-off types of events. So not full packages of major sports seasons, but they did have that World Baseball Classic in Japan. They have some Major League Baseball events in the US. They had opening day. They have the Home Run Derby, the Field of Dream game. So some events that are especially notable. We've seen them do that with the NFL on Christmas Day. So they're moving more and more in that direction, but still not. And they still say they don't want to take a huge step and make a huge monetary commitment. Like we said, we think this is important to have this type of content to ensure that subscribers do need to be there. So the content isn't always on demand, but at this point, it's not a huge part of their business. And if it were to be, it would take a big investment that might help revenue stay much higher, but would come at a cost.
Just finally, Reed Hastings, the co-founder, chairman, stepping down. Do you think that's worrying investors today?
It may be one of the factors, but we don't think that it is or should be a major factor. He has been in the background for quite a few years now. It is very clear to us that the co-CEOs of this company are really the decision makers, the one driving both the strategy and the execution here. And so we don't expect a big change with him stepping down, and we don't think that the stock should be looked at differently with that being the case now. Thanks very much.
Death by Lightning has the assassination of the president played by Matthew McFadden, who the Brit actor who we know from Succession. He's always entertaining. Thank you very much, Matthew. Really appreciate it. Matthew Dolgan, Senior Equity Analyst at Morningstar. Coming up, Hot Picks. We're going to zero in on 3 media stocks. We'll be right back. Hot Picks today, we are zeroing in on 3 ideas in media. Our guest has Roku as his top pick. We're joined by Ken Leon, Director of Research at CFRA. Ken, thank you very much for joining us. We know Roku has millions of devices out there. They're essentially a streaming platform. Can you just remind us, what is the basic service they provide?
So great to be with you. Roku's in a very unique position where they have a platform or operating system that makes it easy for viewers in streaming to really navigate quickly across different network providers. That is a position that enables them in terms of viewership with their devices to be number 2 in the US, number 1 in Mexico. And I think the other aspect about Roku is whether they were going to be at risk to be totally eliminated or replaced. And we really see that they're in a position where they have a durable business model, one that in the last few quarters is not only generating very high revenue, but positive EBITDA and profitability. That's a major change versus the last 10 years. And it speaks to why we upgraded the stock to a strong buy several months ago.
Is that partly because people find it cumbersome switching between, say, Netflix and Amazon Prime?
It really is. Even if you're a household as a pure streamer, it's still sometimes clumsy. And then if you're doing it through a cable provider, maybe in Canada like Rogers, it's even slower. So that ability to be so agile enables them to have stickiness with what they offer, whether it be the operating system itself. It's a lower margin business, but Roku TVs or their smart stick. Ultimately, I think when you look at Roku, they could be very attractive to a larger entertainment company. They also see a chance to open up the door for advertising revenue, which they're able to do with algorithmically in their platform.
Apparently they are famous for keeping it relatively simple for people who are tech illiterate or tech challenged.
That's right.
Sounds like good news. Universal Music Group, Pershing Square Capital, Bill Ackman's outfit, is interested in a bid, apparently. Would you be a buyer of Universal Music right now?
We would. And we've had a buy for some time, I think, getting in at 18. The stock, on the sell-off a month ago was down like 15. And I think first as a backdrop before we get to Bill Ackman and Pershing Square, is that there's a number of high-profile companies that want to be listed in the U.S. market. As it relates to semiconductor, it's Samsung, SG, Hynix. Bill Ackman thinks a stock that's trading on the Amsterdam Exchange, even though their operations headquarters are in Los Angeles, should be trading in the U.S. He also has a proposal. It's kind of like a light kiss of a friendly takeover, whereby his proposal looks to take this company and find different ways to enhance their franchise, including keeping management contracts. So it's an interesting dance that's going on. But what it does is it speaks to Universal Music Group, along with two others, Warner Music Group and Sony, dominate the kind of wholesale part of the exchange between artists, performing artists, and of course, what's then pushed out either in terms of streaming music, like on Spotify, which we have a buy, or their ability to get paid, with live concert performances from other companies. So I think Universal Music Group has been kind of viewed to be a slower grower. But what Bill Ackman's trying to do is try to get more visibility to the value of this company and ways that it can improve some of its performance.
We're really tight for time. We've only got about 60 seconds. If Ackman does take it over, will that be good for Universal? Or if Ackman succeeds in floating it in the US, will that be good for Universal Music shareholders?
We have a $24 target price. I think it's good for investors, public holders. And given the controlling interest here, he also has to get approval from one of the leading European families. So this will be kind of a deal that really needs major shareholders to be in support of this. I like the opportunity.
Finally, we are tight for time, as I mentioned, and I'm sorry about that. Fox trades on NASDAQ. Just remind us what they do. Why do you like this stock?
It's been probably the biggest surprise in the last 2 years, why a company really didn't take a big stab at the streaming market. They do have something that's quite interesting, which is called free advertising or fast streaming. But principally, this stock has done great for a couple reasons. They're the market leader in terms of live news and live sports in the U.S. Secondly, with the Murdoch family having controlling interest here, they are continually buying back stock. So I think what the big surprise was versus asking all media analysts 2 years ago, why would I want to own Fox? It was the major pivot from general entertainment, including streaming, to live sports. And that's what Fox does at a very high level, and the stock has been rewarded. So we like the upside and feel it's still a buy at these levels.
Ken, thanks very much indeed. Really appreciate it. Ken Leon, Director of Research at CFRA. Coming up, two of Canada's biggest banks are walking back plans to cut the carbon footprint in their lending. They are citing energy security and geopolitics. We'll have more after the break. Royal Bank of Canada and Bank of Nova Scotia have abandoned plans to reduce the carbon footprint associated with loans to heavy emitters, such as oil and gas producers. The Canadian banks announced their decision in separate statements. Let's head over to London, where we're joined by Bloomberg ESG and climate reporter Alistair Marsh. Alistair, thanks for giving us the time. Just remind us, what precisely did Royal Bank and Scotia say?
Sure. Hi. Well, they both said that 2030 targets that they had to reduce their emissions associated with lending to high carbon industries, as you said, oil and gas, automotives, etc., will now be scrapped. They're not sticking to those anymore. And Scotiabank went a step further and said, we are not our 2050 net zero target. Those 2030 targets I just mentioned were supposed to align the bank towards this long-term net zero 2050 goal. They've said we're getting rid of that entirely. RBC didn't go quite that far, but essentially Scotiabank has removed all climate ambition, it seems, and both of them have said that they're going to, their targets for reducing emissions in the short term are now gone.
And what are the reasons they're giving?
Well, the reasons on the surface are actually quite reasonable. They essentially say we made these commitments in 2022, and since then, the world has completely changed. The political context is different, both in the US, of course. They don't mention Donald Trump, but of course, it's very obvious that he has completely changed the narrative around climate action and the support for renewable energy. But of course, they mentioned the winding back in the US of some of the Inflation Reduction Act, the big sort of climate green industry supporting act. And then they also mentioned in Canada various initiatives where perhaps support for climate action under Carney has not been as strong as some people thought. They talk about the oil and gas emissions cap, for example. And they sort of give this political context and say, hey, the political winds have completely changed. And without the policy support, industry is not going to decarbonize. And then add on that the energy picture and how that has completely changed now with AI and the demand for powerful data centers. Yes, a lot of that's going to come from renewable, but actually it's a mad scramble for all kinds of energy, which likely is going to mean more emissions as we have more oil and gas. And just, look at the share prices and performance of oil and gas companies. These are companies that, as a bank, you kind of want to keep on your books. And then they also say that some of the technologies that we were going to rely on to be instrumental in the decarbonization journeys, such as carbon capture, have not scaled up in the way that we hoped. And thus, take all of that together, the cumulative effect is that we're not on the path we thought we were, and therefore our goals are no longer realistic and we're getting rid of them. That's essentially what they've said.
I suppose the political and geopolitical environment has changed, but the climate is relentlessly warming. The carbon, it doesn't hang around.
Exactly.
I guess we're tight for time, but it's a great big tragedy of the commons, presumably. Nobody wants to beggar themselves by taking aggressive action.
Exactly. All of these ambitions, these targets were supposed to align, and all that, to be clear, it's not just Canadian banks, US banks, European banks, other banks in Asia all made these commitments to net zero by 2050, because that was part of the effort required to align ourselves with the goals of the Paris Agreement, the keeping temperatures ideally below 1.5 degrees Celsius, which is kind of what's needed to avoid kind of the catastrophic impacts of climate change. That seemed like a laudable goal that we were all moving towards. And just because the politics have changed, as you say, the climate physics have not changed. More carbon is going into the atmosphere, which keeps the world on course for higher degrees of warming, which means higher economic costs. And ultimately, these things are going to show up on the balance sheets of banks. So the climate change is not something that banks can escape, but in the short term, they can certainly change their targets and what they themselves are binding themselves to.
I guess the world has generally decided that truth is just too inconvenient to do anything about. Alistair, thank you very much indeed. Alistair Marsh, Bloomberg ESG and climate reporter. Thank you very much indeed for watching the show. So much going on. Oil plunging on hopes that the Strait of Hormuz is now free, although apparently the Americans are maintaining a blockade on Iranian ports. We're going to be all over that story today. This wraps up the Open. Have a great weekend. Morning Markets is up next.